Next up, we have Joe Belec, who is the RVP for Northern Alberta and Manitoba at Foresters. And his session is Take Your Sales to the Max. And you can expect to learn how Foresters Advantage Max can help win business through case-based selling.
Thanks for having me. My name is Joe Belec. I'm the Regional Vice President for Foresters Financial here in Alberta North. And we have a team, of course, across Canada here to support you. We're going to stick on the participating whole life theme today. And I'm just going to give you some information about the brand new Par Whole Life that Foresters launched very recently. Just about 2 months ago or so, this product hit the market. So we've got about half an hour here to give you some of the inside scoop on that. And if you like what you hear, you want some more details, please reach out to myself or our team across Canada, and we'd be happy to go into some more detail for you today. Quick agenda for you. We're going to have a look at the new product. It's called Advantage Max. We'll talk a little bit about Foresters Financial. If you haven't heard of us before or used us before, we are a bit of a unique company in Canada. We are a fraternal life insurance company. And what's nice about that is we have some additional member benefits that come across all of the products that we offer to your clients. And we're going to show a couple of case studies about how this product can work for you, a couple of prospecting ideas with that, and then how to get started. Okay, let's just start off by saying that Foresters actually offers two Par Whole Lives now. The existing product that was on our shelf and is still there is called Advantage Plus. So that hasn't gone away, and it's basically the same as it was before. And now we've added a second product to the shelf called Advantage Max. So Advantage Plus, Advantage Max are two participating whole lives with Foresters. I'll just put all of this information on the screen for you. You can have a read as I'm talking about it. But why did we launch Advantage Max when we already had Advantage Plus? And the reason is just that the two products offer a little bit of a different opportunity for your clients based on what they're looking for. Advantage Plus is more designed for pricing, for premium, trying to deliver the most death benefit for a certain premium level. And we can achieve that with our enhanced dividend option. So if you have a client that's still looking for a permanent life insurance product, but more of that affordability element to it, that's where Advantage Plus will be a nice offer. That's the one that's already been on our shelf for a while. It does offer that lower premium for the death benefit you can provide, and that'll continue to do that moving forward. The downside to Advantage Plus is to deliver that lower premium, it wasn't as strong with cash value growth. And so what we delivered, or we've been building and brought it to the market now, is Advantage Max. And that's the core focus of Advantage Max, is providing that very strong cash value growth opportunity. It's still an estate par. Actually, both of these products are estate pars. They are designed for that long-term growth. But the Advantage Max really starts to take off in years 10 plus. And so if you have a little bit of time to build up over 10 years or more, this is going to see a very strong cash growth throughout the lifetime of the contract. Of course, the best way to achieve that would be through paid up additions as the dividend choice. And the type of the markets that this would be a good fit for would be things like the juvenile market, maybe an insured individual retirement strategy, business continuation, that type of thing. So we don't have time to get through all of that today, but those are some of the types of clients and opportunities that this will be a good fit for. I should also mention that we are in the process of merging our e-apps. So we currently have two e-apps. The new product, Advantage Max, is on our brand new e-app platform called App Pro. And all of the other Foresters products are on the other version called Insurance Assist. And we do have a project underway to move all of the older or the existing products onto the new e-app. That'll happen sometime in 2026. But for now, there's two separate e-apps. The new product has a new e-app. Everything else is on the existing e-app until it moves over. To get started with today's conversation, I'm going to talk a little bit about the juvenile market to start with. Now, if you don't already operate in this market, I find it's a very valuable market to do for kids. All I would suggest or recommend when you're getting into the juvenile insurance discussion is work through the conversation with the client, and there is a bit of a tendency for a client to focus on the insurance element and thinking about loss of a child. And that's really not the purpose of children's insurance. It's not focused on the life insurance element. down the road that does come into play. But what we're really doing for juvenile products is to set that child up for success, give them those opportunities in life to get a head start, accessing the cash value that could be available inside of the par whole life policy, so that when they get into their 20s and 30s and they're doing things like going to post-secondary school, maybe buying a car or a home or getting married, they have access to this cash value to help support them through that. And that's really that foundational approach that we want to navigate or steer that discussion towards for that. But why this is such a great market is I'm sure you deal with a lot of parents and they may have young children where this is a nice discussion. But not only that, maybe you're dealing with somebody in that family building stage. Maybe you've done some insurance planning for them and you haven't got to this next conversation about juvenile insurance, but maybe there's some budgeting issues for that parent to do this. Well, there's a warm lead, a nice introduction maybe you could have to the grandparent. And grandparents, in my experience, love dealing with love supporting their grandkids. They love their grandkids. And it's a wonderful opportunity for them to provide a foundational plan to set that grandchild up for success. So you could talk at the parent level or the grandparent level. And if you haven't done that, that's a nice lead into that other generation. Maybe you deal at this level, but the grandparents, there's a conversation there. And once you get introduced to the grandparent, there's other planning needs. Maybe there's some estate planning needs that you could work with at that other generation. So it just opens up some doors, some discussions, some opportunities for you. And that's what I love about the juvenile planning. What it does as a par whole life, it provides all these things you can see on the screen: the guaranteed cash value, the death benefit, the guaranteed premiums, those loan provisions. And of course, because it is par whole life, it will earn dividends, and those dividends are just going to grow the policy that much more throughout the lifetime of the client. So a nice analogy you can provide to a family, a grandparent, or a parent talking about this is you're building that foundation, that financial plan starting point. You've got a child who's newborn or 1 year old or 2 years old. If you set up a policy for them, it's going to pay those dividends, no pun intended, down the road. So think about that par whole life as that foundational structure. You're planting the seed today that's going to grow into this wonderful, fruitful tree down the road with the value and the power of paid up additions. So think of it like planting a seed. It's going to grow into a sapling. It's going to grow those branches, and those paid up additions are maybe either the leaves and the branches growing over time, or maybe the fruit that you can then pluck, let's say, down the road. But a nice little analogy that people will understand why you're doing some children's planning. Okay, some specifics about the policy. We can offer single life, and we can also offer joint last to die. 10 pay and 20 pay are available, as well as a pay to age 100. And you can see a little bit of a difference there between if you're doing the enhanced insurance and if you're doing paid up additions. But generally speaking, 10 pay, 20 pay, life pay, and 18 through 75 or 18 through 85 for those issue ages. Or sorry, I said age 18. I meant to say age 0 potentially, just depending on what you're looking for. If it's joint last, it's age 18, but we can go all the way to age 0. 15 days old would be the minimum age for single life for a juvenile. Some more specifics: the minimum coverage amount is $50,000 to a maximum that's quotable in the software of $10 million. We can go up to a $20 million quote, but we'll go through our special quotes process for that. So if you do have a larger case, let us know. We can work through that. Accelerated underwriting up to $1 million without the requirement for lab work or parameds. And one little note about rate banding. I'm sure you're aware of rate banding, which basically means as you get into a higher amount of coverage, the cost per thousand of coverage goes down a little bit. So it's a little bit cheaper for a higher amount of coverage. But I just pointing this out because our software helps you with this. If you're quoting an amount that is maybe just below a rate band, it will identify that for you and say, hey, you know what? Why don't you bump the amount of coverage up just by a little bit, and you can actually reduce the premium. So it'll automatically identify any of those situations where it actually is more worthwhile to go to a higher coverage amount and lower the premium for that client. The dividend scale, 6.25% this year. I don't have a crystal ball to know what our next year's scale is, but we do announce this every year. And that's really the power of Par Whole Life. I was listening to Brant backstage too, and he was talking about using participating whole life as an asset class. And one of the reasons why that's so powerful is a dividend that just pays out year after year. It plugs into that policy, and it's just this growing asset for that family, for that client over their whole lifetime. I'm a big believer in it. I own it on myself. I own it on my children, and so hopefully it's something that you incorporate into your practice as well, because it is one of those great products that it's low maintenance. You just pay your premiums, and it's just going to do its thing for forever, basically. As long as you keep that policy in force, you're going to be thanking yourself 20 years or 30 years from now for that decision you made. And that's another message you can get across to a client is make that decision today, because when you get to that age, when it's 20 or 30 years later, you're going to be looking at that policy that you bought 20 or 30 years ago and say, wow, I can't believe what's been growing for this. And it's just going to continue to grow for the rest of their life. Of course, one of the big things about Par Whole Life is you do have access to that cash value. And one of the common ways to do that would be through policy loans. You could also use a collateral lender. We have an agreement with a company called EQ Bank for collateral lending. But if you're doing a direct policy loan internal with Foresters, our interest rate is currently 5.75%, which is very competitive in the market. And they can access up to 90% of the cash value at that time as a loan. They don't necessarily even have to pay that loan back. They could let it ride. It will accumulate interest, and it'll eventually be cleared off the ultimate death benefit at that time. But some people will do that, and they'll use this policy as a way to access cash for whatever purpose they need. And they don't have an intention to clear it off. And then down the road, it will be cleared off with the remainder going to those beneficiaries. Okay, quickly, just to talk on some of the built-in features. I'm not going to focus on the optional riders. Those are all optional at a certain price point for whatever rider. But the ones that are built in, these come included with no extra policy premium for those. So we have a children's insurance benefit. What that means is the children of the insured automatically receive coverage under this without any evidence of insurability or any cost. So it's $3,000 of coverage with a conversion opportunity of up to $10,000 to convert that when they are an adult to their own permanent policy without evidence. So even if the children are considered uninsurable today, they automatically qualify as part of this children's insurance benefit. And if both parents bought a policy, you can double those numbers. So it'd be $6,000 of death benefit with a $20,000 conversion rate without any evidence. So it's really powerful, especially if you're in a situation where they have an uninsurable child, they automatically qualify for coverage through that. Quit smoking incentive, that's a great feature from Foresters on our permanent policies, where if the client is a smoker, we will classify them as a non-smoker for the first 2 policy years. If they're able to quit smoking, they get to maintain that rate. If they're not able to quit, starting in year 3, we'll bump them back to what that smoker rate should have been. But for 2 years, they receive a discounted premium. So it's a nice way for the client to save some money, hopefully encourage them to quit smoking, but that's automatically included on our permanent insurance policies. The charity benefit provision, an additional 1% of the base coverage amount. The client gets to name a charity of their choice as long as it's registered in Canada. And when they pass away, that charity will receive that 1% of that base coverage amount. And the donation comes from the client. It's not coming from Foresters. It comes in the name of the client, which is nice because that charity will then trigger a charitable donation tax receipt for that, which is in their name, so they can use it to help offset those estate taxes a little bit. And that's all automatically included. They don't have to name a charity, but it is available. And then finally, Teladoc Medical Experts. That's a service. There's a number of services under that. The big one would be the expert medical opinion program, where if they are dealing with a condition or an illness, they have access to a second opinion service from a world's leading physician in that area of medicine that they may need some support with. And again, that's part of the base policy. So I don't have time to get into everything, but I just wanted to give you a quick little rundown of some of those built-in features at no extra cost. So let's switch gears a little bit and talk about who Foresters is and why you should consider this product. Well, first and foremost, Foresters has been around in Canada for 151 years. So been around a long time. I hope it'll be another 150 years plus into the future. But one of the reasons why we've been able to be successful and been around so long is we do like to keep our capital reserves in good standing, good strength. And we usually always operate at the very high end of the industry for LICAT ratio, just to make sure that we can make good on all of those promises we are making to our clients and your clients. And ultimately, that's what a client cares about is, will this company be around to pay its claims? And the answer is yes, we have the strength to do that. I'll leave this slide up on the screen here for a little bit. If you do have a phone in front of you, you can scan this code, and this will give you access to learning more about the member benefits. I'll just pause there and mention Foresters is a fraternal life insurance company. And if any client purchases a policy with Foresters, the life insured of that contract automatically becomes a member of Foresters. There's no additional cost, nothing you really have to do or not do. It's part of the deal. You just buy a policy, and once it's in force, you are a member of Foresters, and that provides you access to our suite of member benefits. There's a whole number of things. Hopefully, I'll have some time to touch on some of them. Things like our Law Assure tool, which allows the client to create a free will, power of attorney, and healthcare directive. There's scholarship opportunities. There's a number of charitable programs where they can support local charities that they're interested in supporting, giving back to the community, and a whole range of other things. So this is all part of what we do as a company. Just scan that QR code and you'll be able to learn more about all of those member benefits. Okay. So what we're going to do, talk about with Foresters as a company, is winning these three elements, winning the mind, and that's part of the Foresters member benefits, providing the right solution, learning about the client, doing all those things you do. Winning the business is the product solutions that are a good fit for the client, and then winning the heart is through going above and beyond, providing those member benefits to the client, and that's just giving them more value for their premium dollar. And hopefully, once you do a good job of all of those things, they're going to be a client for life. And what I found and what advisors have shared with me is when they use a Forester solution and the client gets engaged with Foresters, maybe does some of the granting programs, their child gets a scholarship from Foresters, those become amazing referral sources for them in the future. I had one advisor here in Edmonton tell me that their client did win one of our scholarships. And they get so many referrals from that client now because they were the only advisor that they worked with that also supported their child going through post-secondary school. And so the client was just so happy about that. Anytime a conversation comes up in their own life about insurance or financial planning, they refer that individual to their advisor who had done a great job just by having these member benefits. So keep that in mind. There are ways that you can use these member benefits as opportunities to grow your business in perhaps unexpected ways. Okay, I've only got maybe 5 or 10 minutes left, so I'm going to focus on a couple of markets that you could use this new product Advantage Max on. We have a couple of case scenarios here. One of them is a retirement planning with life insurance solution, and then the other one is a juvenile solution. So we're going to start with Martin, and this is a retirement planning with life insurance. Martin's 35 years old. He's growing his family. He's got a daughter and a wife. And of course, he still needs some life insurance at the element or the base level of this. This is still a life insurance policy. So the client does need to have a life insurance need. And Martin does, as he's growing his family, he has a need for life insurance. And he's got short-term and long-term obligations that he's looking to take care of. But beyond that, beyond just the life insurance need, he's also looking for a way to supplement his retirement income. Maybe he has some TFSAs or some RSPs, but he's looking for some additional ways to help supplement that and support those retirement years when he gets there in the future. So that's the power of this Par Whole Life. We can show you how you can do that. And in this case, what we're going to do is work with Martin's budget, which is $6,000 annually and for 20 years. He's prepared to commit $6,000 a year for 20 years into this policy. There's a mix of short-term and long-term needs. So we're going to use a mix of the base whole life with some term insurance to achieve the short-term need, the whole life for that long-term need. And so we'll use some term as part of that. So let's skip through a little bit. We're going to build out this plan. It's a 20-pay plan. We're going to do a $6,000 premium solve and include a term 20 for $400,000. The base coverage is about $217,000. So So now we've solved the client's need for insurance and achieved also the budget that he has for $6,000 annually. But once you look at the illustration, you can see the premium commitment. So Martin knows what he has to pay into this policy, which is $120,000. And you can also see the cash value, the guaranteed cash value that will grow down the road. What we're looking at in the little box on the screen is the guaranteed values. But because this is participating whole life, we also have our non-guaranteed values based on our current dividend scale projection, where you can see the cash growth in year 21 being roughly 177,000, with the death benefit growing to 404,000 at that point. And I should mention the term 20 has dropped off. So it's just the base 217 that has now grown to 404,000. We've illustrated the term rider to drop off after 20 years. But the power of this policy is the ability to access this cash value down the road. So for Martin, starting at age 65, he can withdraw a $15,000 loan for 20 years out of the policy. And when you illustrate this in the software, it will calculate the after-tax amount. Any amount over the adjusted cost base could be subject to tax. So that's accounted for in the numbers. So you can see the loan amount, the after-tax loan amount. But eventually what's happening here is Martin is withdrawing $312,000 out of the policy. After tax at 36% marginal tax rate would be $224,000 out of the policy. Oh, there's no slide to summarize that. But if you go back to the beginning, Martin has paid in $120,000 in premium. He's subtracting, or he's taking out $312,000 in retirement, effectively more than double what he's put in as a premium commitment. He's taking out as a retirement income stream, and he also still has a remaining death benefit net of policy loans. So what we're illustrating here is there's a growing loan balance. He's not paying back that loan, but in the far right column, we have the total death benefit net of those policy loans still being available for that legacy. So it works really well for someone in their mid 30s to mid 40s, this type of policy where they can commit a premium, and down the road, they have the opportunity to use that cash value to support those retirement years. Now, the last little one I'll end on is the Con family, which is a juvenile market. So we've got the grandparents. This is talking to that grandparent level. They want to support and set their grandchild up for success in life. And so they're looking for those guarantees. They want that permanent protection that's very stable and guaranteed for the grandchild. And they're comfortable with a $3,000 annual premium. So let's quickly set this up. We're going to do it as a 20 pay. There is a built-in juvenile guaranteed insurability benefit. So it's automatically included. And then there's an optional rider on top of that you can add to essentially enhance it. But included in the base plan, there's a juvenile rider. And these are the things that you're trying to achieve with a juvenile plan. You want to grow the policy. It's the accumulation that that child will have access to that money down the road. The insurability element to it is a very big, important element to this, is to protect that child, to make sure that they have this coverage. And if something did happen to their health throughout their lifetime, they have not only the coverage right now, but an opportunity to purchase additional coverage without any evidence insurability. So you're locking in that insurability for the child. And then eventually it's that legacy. That child will grow up, and they're going to have maybe a family of their own and their own beneficiaries. And you've built up this policy that is setting up that legacy gift for that grandchild. So those are the foundational pillars. Let's quickly look at it here, just to give you an idea of how this is so powerful for grandparents to look at. You can commit in this premium, and then when that child is now 18 to 21 years old, they've got value inside of their policy that can help support, maybe if they're going to post-secondary, or maybe they're getting married at 25, they've got over $100,000 there to help support those costs, of a wedding, which is not cheap. Even down the road, maybe now they're starting to build a family. They've got maybe $150,000 of cash that's now grown up to help support those the family building years. And maybe they're buying a home in their mid 30s, and now they've got $200,000 to help them put a down payment towards a home. So you've just, as a grandparent, you've set your grandchild up for that future success by putting in a solution for them years ago that's paying off dividends throughout their lifetime. So as I mentioned at the beginning, if you haven't thought about this as a conversational piece with your clients, I really encourage you to bring it up, especially at that grandparent level. They may have some disposable income to put towards this. They want to support their family, their grandchildren, and even long after they may be gone, that child, they can thank their grandparents years later for that amazing policy and support that they provided to them. So I really do encourage you to think of this as a potential market for you, maybe some new introductions to get to introduce to some new clients. And we'll just wrap it up there. Oh, by the way, if they do purchase additional insurance in the future, as an advisor, you also have those new commissionable opportunities down the road. Um, so I'll think I'll wrap it there. We're almost out of time. If any of this spoke to you, you want a little bit more detail about our product, some of the features, a little bit more about Foresters as a company and the good that we do in our communities, we'd love to chat to you about it. I live in Edmonton, and I support advisors in Alberta North and Manitoba. But if you're across Canada, we have a team happy to chat with anything that you want to learn. So thank you so much for your time. I think I'm actually a couple minutes ahead of time,
Yeah,
but
we've got some questions coming in, Joe, if you're okay with it.
okay,
Awesome.
sure. I don't know if I
Great.
can see the questions. Can you ask?
That's okay.
Read
No,
them?
no, I'll read them to you. Don't worry about it. So first of all,
Sure.
thank you. This was excellent. Yes, there are a number of par whole life solutions out there, but in my mind, that's a great problem to have because it gives advisors choice and it means that clients are going to get a solution that best works for them. So great to learn about Advantage Max. I know this is kind of hot off the press, and as with any new product launch, I know advisors have questions. So thanks for mentioning the sales team out there. I'll also put a plug in for your BDEs at IDC. Those are the folks you should be going to help compare carriers and cases and that kind of thing, and then also put you in touch with the appropriate people at the insurance companies. So great, Joe, and we'll do these as quickly as we can. So question here from Robert: for juvenile rates, does it switch to non-smoker rates after age 17 without medical evidence?
Our juvenile rate is a blended rate, so it just the rate will be the rate that it is for life. So whatever you set up at front, where you quote in the illustration, that's going to be the rate that it is for the premium duration. So if you did a 10 pay or 20 pay, it's set like that, or the life pay will just be set up from the outset.
Brilliant. Harvey's wondering what's the difference if you choose the dividend option versus paid up additions versus enhanced insurance.
Great question. I don't know if I can answer that in 30 seconds here, but essentially paid up additions provides the dividend is going to buy those paid up units, and that's going to grow the policy. Enhanced is a little bit different, where the dividend is still buying paid up additions in the same way, but the coverage amount you're buying is a mixture of a base amount of whole life and the enhancement, which is a 1-year term insurance. And as you get those dividends to buy paid up units, there's basically an internal replacement to convert those 1-year term units into whole life units over time. So there's a period of time where the enhanced units will be replaced by those paid up units that the dividend generates. And so it's not going to grow quite as fast, but it's at a lower price point. So long story short, it's a lower price point, but it's a nice mix of par whole life. You get that future growth opportunity, but maybe at a more affordable price point for the client.
Love it.
That's as
Great
fast as
answer.
I
No, no,
can
that's good.
answer
Good.
that.
And Joe is available. Like you can always reach out to him for more detailed explanations. A few more coming in light of, so this is from Christina, in light of the mention of CTR covering uninsurable children, would a child who is diagnosed with autism today be able to qualify for the rider? They are previously excluded based on medical info. But if this is
So if you're doing a juvenile plan, the child, if the life insured is the child, then they may not qualify. They do have to qualify medically for a juvenile plan. But if the parent has a policy, there is a built-in children's insurance benefit where those children are automatically included as part of the parent's policy. So it just depends on who the life insured is there. If the child's life insured, they do have to qualify for that. But if the parent is a life insured, then those children are automatically included as part of that children's insurance benefit.
good stuff? Thank you. Two more from James for the previous example, talking about supplementing retirement income through the par product via policy loan. Is this loan being paid back at all, or did I miss something?
No, in the example I showed, we did not pay the loan back. So the client definitely would have the decision to do that, or the choice if they wanted to pay the loan back. But in our example here, they are not paying it back. It is an accumulating loan balance with interest, but it will be cleared off the ultimate death benefit. So in this slide on the far right column, you see the total death benefit net of policy loans. That's after clearing that loan balance off at death.
Good. Two more, lots of great questions here, which is awesome. Melba's wondering if grandparents are of advanced age, can they set aside enough premiums for 20 years within the plan?
Um, we do have something called premiums in advance, where they can actually provide us premiums in advance, and we'll hold it onto it in a side account and draw from that as needed. So that could be a solution there. Another idea could be premium offset. So if you set it up as a 20-pay plan, that doesn't necessarily mean they have to pay for full 20 years. There may be an opportunity, a premium offset ahead of that, to maybe only pay for 13 years, let's say, or something of that nature. Not guaranteed, but there are a couple things we can do, we can chat about to maybe do that for an elderly client looking to set this up.
Great. Last question and a comment from me, and he says loves the fraternal benefits, which is great, and he's wondering if this is available for present and future children.
Yeah, I'm not sure if I'm following the question. The life insured of a contract would be the member. If the future children, they could apply for a plan in the future, but it does, if we're going back to that children's insurance benefit, it does include future children as well. So I'm not sure if that was the question there, but yes, future
We'll ask
children
the
under
individual
the,
charity. Yeah, okay.
yeah.
That's helpful. Awesome. We'll leave it there, Joe. There are a number of questions coming in still, which is a great sign. So we'll put everyone in touch with Joe or their local representative just to be able to finish off with those questions. But Joe, thank you. This was a great presentation. Great to learn about the new product.
Well, thanks everybody. Thanks for having us. And yeah, we'd love to touch base. Enjoy the rest of your day.
Appreciate it. Thank you.